A lot of you idiots have no idea this even exists. Every 3 months, the smartest investors on the planet are legally forced to show their cards. Not motivational quotes, not fake screenshots, actual positions, actual money. It's called the 13F filing, and if you've never heard of it, that's already a problem. Because while you're arguing on Twitter about which crypto is going to the moon, or whilst you're doom-scrolling Instagram getting excited over big bundas or men who will never look at you twice because you expose your bits online for attention, the real players are quietly moving billions behind the scenes. And every 90 days, the curtain opens. You get to see what the people managing tens of billions are actually buying, not what they say, what they do. Now here's the funny part. Most retail investors ignore this completely, which is insane. It's like being allowed to look over the shoulder of the best poker players in the casino and deciding you'd rather watch TikTok instead. But this quarter, this one was different because some of the biggest names in finance made serious moves worth hundreds of millions. And one company kept appearing again and again and again and again and again. Amazon. So let's start with the first big move, because two serious investors suddenly did the same thing. They started buying Amazon. Not small buys either. We're talking hundreds of millions. Seth Klarman opened a brand new Amazon position worth roughly $500 million. Straight away, it became the second largest holding in his portfolio. That's not curiosity, that's conviction. Then Bill Ackman did something similar. He increased his Amazon position by 65%, which now makes it one of the biggest investments inside the Pershing Square portfolio. So now you've got two investors managing tens of billions, both deciding Amazon deserves a serious allocation. Now here's where people start doing something stupid. They immediately think, right, smart investors bought Amazon, I should buy Amazon. That's lazy thinking, because copying trades without understanding the thesis is exactly how retail investors lose money. The real question isn't what they bought. The real question is why. Because when you understand the logic behind the move, you start to realize something interesting. Amazon isn't really the business most people think it is. Most people think Amazon is an online shop, big warehouse, delivery vans, prime boxes turning up at your door. And yes, that part of the business is massive, hundreds of billions in sales every year. But here's where the story gets interesting. Because the thing that actually makes Amazon serious money isn't the online store, it's the cloud. Amazon Web Services, AWS. Now this is where the numbers start looking ridiculous. Amazon's retail side generates the majority of the revenue, but when you look at profit, the picture flips. Retail brings in mountains of cash, but it's expensive. Warehouses, staff, logistics, fuel, returns. AWS is completely different. Once the infrastructure is built, the margins are far higher. Think of it like this. Retail is like running a supermarket. Lots of customers, huge turnover, but tight margins. AWS is like owning the electric grid the supermarket depends on. Everyone uses it, everyone pays, and the economics are much better. Right now, AWS is responsible for more than half of Amazon's operating profit, despite being a much smaller share of total revenue. Which means when investors buy Amazon today, they're not really betting on online shopping. They're betting on something much bigger. And that something bigger is happening right now, AI infrastructure. Amazon is planning to spend around $200 billion building new data centers. Not millions, billions. Now, when people hear numbers like that, they panic. They think the company is wasting money, burning cash, making reckless bets. But that reaction usually comes from people who don't understand how these businesses work. Because in cloud computing, capacity is everything. Imagine running a motorway. If you only build 2 lanes, you can only handle a certain number of cars. But if suddenly millions more cars want to use that road, you either expand the motorway or you turn away traffic. That's exactly what's happening in cloud computing. Demand for computing power is exploding. AI models, machine learning, data processing, every tech company needs it. And Amazon knows something important. If they build the infrastructure first, they get to collect the tolls later. Which is why companies like OpenAI, Visa, the NBA, Adobe, and dozens of others are signing huge AWS contracts. This is the part most investors miss. They look at Amazon and see shopping. The big money investors look at Amazon and see the backbone of the internet. Now, while some investors were loading up on Amazon, someone else was quietly doing the opposite. Warren Buffett. Because this quarter also marked something historic. It was the final 13F filing under Buffett's leadership at Berkshire Hathaway. The end of one of the greatest investing careers ever. And when the filing dropped, people expected fireworks, huge trades, big final bets. But Buffett did something far less dramatic. He kept doing what he always does, quiet adjustments. Berkshire trimmed its Apple position again, cutting roughly another 4%, which is interesting because just a few years ago, Apple was almost half the portfolio. He also reduced Bank of America slightly, then added to Chevron and increased the position in Chubb Insurance. Nothing crazy, just the slow steering of a very large ship. And that's the key thing people misunderstand about Buffett. They expect dramatic moves, but his entire strategy is built around patience. Think of it like steering a massive oil tanker. You don't jerk the wheel left and right, you make small adjustments and let time do the heavy lifting. Because over the long term, those small adjustments built one of the most successful investing records in history. Now, while Buffett was quietly adjusting positions, Bill Ackman made another big move. He bought Meta. And not a small position either, roughly $1.7 billion worth of shares, which immediately pushed Meta into the top holdings of his portfolio. Now here's the interesting part. Meta had just dropped about 25% from its highs, which is exactly when disciplined investors start paying attention. Because great investors don't buy excitement, they buy temporary weakness. Ackman's thesis basically comes down to 3 things: AI, moat, valuation. First, AI. Meta is pouring billions into artificial intelligence, improving recommendations, improving ad targeting, improving engagement. Second, the moat. Facebook, Instagram, WhatsApp, Messenger, billions of users. That kind of network effect is extremely difficult to break. It's like owning the busiest shopping center in the world. Everyone shows up there because everyone else is already there. And then there's valuation. Despite the company growing rapidly, Meta still trades at a lower multiple than many big tech companies. So Ackman's view is simple. If AI improves the product and the moat stays intact, the long-term upside could be significant. But not all the news from this round of filings was exciting. Some of it was actually pretty sad. Because one of the most famous investors from the financial crisis, Michael Burry, has officially closed his fund. Scion Asset Management is gone. No more 13F filings. No more quarterly position reveals. Which is strange when you think about it, because Burry built his reputation doing something most investors are too scared to do, going against the crowd. When everyone believed the housing market was unstoppable, He saw the cracks, and he bet against the entire system. It's like watching a building slowly tilt, while everyone inside insists the structure is perfectly fine. Burry noticed the tilt, everyone else noticed the music. But now that the fund is closed, there's an interesting twist. He's actually talking more, not less. Posting his thoughts online, sharing opinions, writing about markets openly. Which means, ironically, we might now hear more from Michael Burry than we did when he was running Billions. So what should you actually take from all of this? Because this is where most people get it wrong. They watch these filings, see what Billionaires bought, and immediately try to copy the trades, which is stupid behavior. Not stupid people, stupid behavior. Because these investors are playing a completely different game. Different time horizons, different capital, different risk tolerance. It's like watching Formula One drivers and thinking, right, I'll drive like that on the motorway. The value of 13F filings isn't copying the move. It's understanding the thinking behind the move. Why are investors buying cloud infrastructure? Why are they interested in AI capacity? Why are they willing to buy Meta after a pullback? Those questions matter. Blindly copying trades doesn't. Because the smartest investors in the world don't just buy companies. They buy long-term narratives. And if you start thinking that way, you stop chasing hype. You start analyzing businesses. And that's when investing actually starts making sense. But here's the part nobody tells you. Just knowing what billionaires buy doesn't make you a better investor. Information isn't rare anymore. Execution is. Everyone can see the filings, everyone can read the news, everyone can watch videos like this, but very few people actually build the discipline required to think long-term. Because the market constantly tries to drag you back into short-term thinking. Daily price moves, breaking news, hot stocks. It's like standing in the middle of a casino while trying to think like a business owner. The smartest investors ignore most of the noise. They focus on a small number of businesses. They understand them deeply, and then they give those ideas time. Which is why someone like Warren Buffett could turn a single dollar in 1965 into more than $55,000 today. Not by chasing trends, not by reacting to headlines, but by patiently owning great businesses for decades. That's the real lesson hiding behind these filings. The goal isn't to copy billionaires. And once you understand that, something interesting happens. You stop obsessing over the next trade, and you start paying attention to where the world is actually going. Because markets aren't random. They're reflections of real economic change. Cloud infrastructure expanding, artificial intelligence scaling, digital platforms dominating attention, energy systems evolving. These are not trends that disappear next quarter. They're multi-decade shifts. And the investors who consistently win position themselves early. Then they sit still, which is incredibly boring and incredibly profitable. So the next time a new set of 13F filings drops, don't just ask, what did they buy? Ask a better question. What do they see that the rest of the market hasn't noticed yet? Because once you start thinking like that, you stop reacting to the market and you start understanding it.